Well, could the worst finally be over for commercial real estate? CEO of one of the largest players in that space, Walker and Dunlop's Willy Walker, joins us to talk about a lot of things. We always have you on. First time, though, we've had you on that the Fed has started cutting rates, Willy. And I guess my question to begin is, will things get more active again as a result in commercial real estate?
No doubt. I look back, David, to being here 2 years ago and where we were in a wildly inverted yield curve at that time. And everyone was saying we're into a rate tightening phase and things were going to look bad. And we've gone through 2 years of tightening. And now we're back into an easing phase. And you've already seen it start to impact volumes in commercial real estate as it relates to refinancing volumes. Sales volumes are picking up. So, yeah, you're looking forward to a very distinct next couple years for commercial real estate from where we've been for the last two.
All right, we've also been talking here about a potential crisis in commercial real estate, at least in the balance sheets of certain banks that have lent heavily as a percentage of their overall portfolios. Are we through that as well? Did we make too much of it over the last couple of years?
Well, I don't think we made too much of it in the sense that it was clearly a significant concern, especially after Silicon Valley Bank went under. With that said, crisis averted. And quite honestly, if you think about how the Fed thread that needle as it relates to avoiding a downturn in the economy and rising rates so high, it did have the ability to break something. And clearly it's broken individual deals, but fortunately it hasn't broken another financial services institution subsequently. And you look at delinquency rates in commercial real estate, and they've been pretty stable right now. In August, you had a number of new loans that went defaulted, but at the same time, you're also getting curing at the same time. And so the delinquency rate stayed stable in August of some new ads, but then also some other loans that got cured. So you're at that inflection point, I would think, where you start to move down on that number.
But to the extent that your equity has gone down and you need to actually increase the debt and you can't do that, I mean, are a lot of these owners still in the same place and or lenders, or does rates coming down, let's call it another 150 basis points from here, really help?
It super helps. But, you got to keep in mind, the 2/3 of commercial real estate debt outstanding is fixed rate. So it's only a third we're talking about. And so you get a 50 basis point pickup, and it's not all of a sudden saving everyone's day. With that said, most commercial real estate construction loans are floating rate. So if you've got a project that has just come out of construction, it's floating rate debt. You want to be able to put permanent debt on it. The cost of permanent debt is down significantly. That helps the market a lot. But we've got a lot more cutting to go on the short end of the curve to get back to a normalized yield curve. And once we get to that, then the market can really start to function again.
What kind of curve would you want to see?
What do you mean by that, Carl?
I mean, just short rates versus long. What would connote health, I guess?
I mean, one of the big things that, look at where the 10-year was last week before the Fed announced their 50 basis point rate cut. The 10-year was down in the 360s. Okay, today it's about to get to 380. Okay, so one of the big things was everyone bought on the rumor, if you will. Then all of a sudden they come in with 50 basis points, and all of a sudden it starts to move back up. I think a lot of people have been waiting for the long bond to come down even further, and I'm sitting there going, how much further do you think it's going to go? Because you've got to get the short end of the curve down so far over the next year and a half. And so you clearly, right now, the market is telling you you're going to have a Fed funds rate down around 250 a year and 4 months from now. We'll see if we get there. But it's going to be a very healthy market for commercial real estate as rates start to come down.
I wanted to ask you about residential real estate and what you make of some of the campaign promises from the Harris campaign to stimulate more affordable housing, tax incentives to build first-time home buyers and rental buildings, money for first-time home builders. You think that's going to be effective?
So, Sarah, there's a couple things there. First, you've got to think about the shift in policy from Biden calling for 5% rent control on a nationwide basis to Kamala Harris calling for 3 million new homes being built in America. That policy shift is unbelievable. I mean, you're going from a very progressive, control the market to a very free market, let's put supply into it. So that alone is a huge shift. With that said, building 3 million new homes in a year, it's too much. We're at about 1.1 million right now. You need to get up to about 1.5 million so that the obsolescence that happens in the market doesn't get eaten up by demand. But we need more housing in America. The thing that would be nice is to see the Trump campaign come out with a proposal that's distinct or similar to the Harris proposal, which just says, here's what we're going to do about housing. Because housing is a very big issue
but isn't
in
it just cut the red tape, deregulation?
Oh, big time. But what you're focusing on there is all the money sits in Washington and all the control sits at the local level. Local jurisdictions control land use and land entitlement. And so until you connect the dots between the money in Washington and the land use policies at the local level, you're not going to solve the problem.